Guys, knowing when to buy a stock is one of the oldest questions in investing. And honestly, even the pros don't have a crystal ball. Instead of trying to guess the exact perfect day, successful investing usually comes down to checking a few specific boxes. Here's what to look for when deciding if it is a good time to buy. One, when the price is right, the valuation. Just because a company is great does not mean its stock is a buy at any price. If you want to look at valuation metrics to see if the stock is trading at a reasonable price or a discount. Price to earnings, the PE ratio. Compare the stock's current PE ratio to its historical average or to its industry competitors. If it is significantly lower without a fundamental problem in the business, it might be on sale. The margin of safety. This is the gap between the stock's current market price and its actual intrinsic value, which is what it's truly worth based on fundamentals. Buying with a solid margin of safety helps protect your capital if the market gets bumpy. Number two, the business is fundamentally strong. A temporary drop in a stock price is only the opportunity if the underlying business is healthy. Ask yourself, does the company have a strong economic moat, which is a competitive advantage that protects it from rivals? Is its debt manageable? And does it have enough cash flow to survive a market downturn? If the price drop due to temporary market noise, like a bad macro headline rather than a permanent flow in a company's business model. Number three, during a market correction or sector sell-off. Some of the best buying opportunities happen when the broader market panics. The baby with the bathwater effect. When the entire market drops due to macroeconomic fears like inflation or rising interest rates, excellent, high profitable companies often get dragged down along with the bad ones. Next, the sector rotation. Sometimes institutional investors pull money out of the entire sector, like tech or financials, to put it elsewhere. This can create a great entry point for long-term investors tracking specific high-quality tickets. A quick reminder on market timing. Trying to absolutely time the bottom of a fallen knife is incredibly difficult. Because of this, many investors rely on DCA, dollar cost averaging, which is investing a fixed amount of money at regular interval, like every week or every month. This takes the emotions out of timing, ensuring you buy more shares when prices are low and fewer shares when prices are high. When you are trying to time an entry, technical indicators are great for cutting through the noise and showing you where the market's momentum is actually shifting. To find out when a stock is oversold and hitting a potential turning point, traders usually look at a mix of momentum oscillators and trend following indicators. Here are the heavy hitters most investors rely on to spot a good buying window. Number one, the Relative Strength Index, the RSI. Now, the RSI measures the speed and the change of price movements on a scale from 0 to 100. It tells you whether buyers or sellers are overextending themselves. The signal. A reading below 30 means the stock is technically oversold. It suggests that selling pressure may have gone too far, making it a prime candidate for a bounce or a trend reversal for a long time. It's often safer to wait for the RSI line to dip below 30 and then crosses back above 30 before buying. Number two, the moving averages, the baseline support. Moving averages smooth out daily price fluctuations to show the true direction of the trend. The most important ones for major entry points are the 50-day and 200-day simple moving average, SMA. The signal. In a healthy long-term uptrend, a high-quality stock will often pull back to its 50-day or 200-day moving average. If the price hits one of these lines, it begins to steady or bounce, the market is treating that average as a strong support, making it a high probability entry zone. The golden cross. If you want a confirmation that the long-term trend has officially turned bullish, look for a shorter moving average, like the 50-day, to cross above the longer one, like the 200-day. 3. Moving average convergence divergence, MACD. MACD is a trend following momentum indicator that shows the relationship between two moving averages of a stock's price. It consists of two lines, the MACD line and the signal line, and an histogram. The signal, look for a bullish crossover deep below the zero baseline. When the MACD line crosses above the signal line, while both are deeply negative, it indicates the downward momentum is drying up and buyers are starting to step back. Number 4, the Bollinger Bands. Bollinger Bands consist of a middle line, usually a 20-day moving average, and two outer bands that expand and contract based on market volatility. The signal. The outer bands represent price extremes. When a stock's price drops and touches or pierces the lower Bollinger Band, it is visually and statistically overextended to the downside. Prices tend to snap back toward the middle line from these levels. Relying on just one indicator can easily result in a false signal. The most successful approach is looking for confluence, where multiple indicators tell you the exact same story at the same time. For example, let's make an example of a strong buy signal. A stock drops during a market sell-off and hits its major 200-day moving average. At the exact same moment, its RSI hits 28, which means oversold, and the MACD forms a bullish crossover. When multiple independent tools flag at the same price level, your probability of a winning entry goes way up. Distinguishing between a genuine trend reversal and a dead cat bounce comes down to one core concept: validation. A dead cat bounce is driven by brief short covering or speculative retail buying on a cheap stock, but it lacks institutional backing. A true trend reversal, on the other hand, requires significant buy pressure to permanently shift the supply and demand dynamics. The most reliable ways to separate the two involve analyzing volume, price action, and indicator divergence. Number 1, the ultimate truth teller, the volume. Volume tells you how much money is actually behind a move. It represents conviction. The dead cat bounce, the price spikes up upward or low on average volume. This indicates a lack of institutional buying. If the stock rallies but the volume bars at the bottom of the chart stay small, the big players are sitting on their hands, and the move is highly likely to fail. The true reversal. The price moves up on a massive, above average volume. This indicates institutional accumulation, which means large funds stepping in to buy millions of shares. Furthermore, as the price pulls back slightly after the initial spike, the volume should dry up sharply, showing that sellers are exhausted. Number 2, MACD and RSI divergence. When a stock is making new lows, its technical indicators should generally match that downward momentum. When they don't, it's a major clue. The stock hits a new low, and the RSI/MACD drop to a corresponding new low. When the bounce happens, the indicators remain weak or flat. The true reversal. This is one of the most powerful reversal signals in technical analysis. It happens when the stock's price falls to a lower low, but the RSI and MACD forms a higher low. This shows that even though the price fell, the underlying selling momentum actually weakened. Number 3, price action and market structure. To reverse a downtrend, a stock must fundamentally alter its pattern of lower highs and lower lows. The price bounces aggressively but fails to clear the previous lower high on the chart. It often gets rejected exactly at a major descending trend line or a key short-term moving average. Within days, the bounce fizzles and the price drops to create an even lower low. The true reversal. The price breaks out above the previous lower high, establishing a higher high. Then, when it pulls back, it holds above the previous bottom, forming a higher low. This structural shift, higher high and higher low, officially confirms that a new uptrend has begun. If you want to avoid getting trapped in a dead cat bounce, the safest approach is to never buy the first green day. Wait for the initial bounce to exhaust itself. Watch the subsequent pullback and see if the stock successfully holds a higher low. If it holds on a low volume, the downside risk is significantly reduced. Well guys, I feel I'm gonna wrap this one up here. I hope I gave you some good information on when to buy a stock. Always do your own due diligence. Don't buy or sell a stock just because me or someone on the internet is telling you to do so. Other than that, me personally, I don't use a lot of technicals. I usually buy great companies at fair value. I buy on fundamentals, and I DCA into a security. Like most of you guys already know that follow me on the channel, when I make a decision to enter a security, usually I spread my buys in between, I would say, over the next 2, 3, all the way to 4 to 6 months. It depends on the market conditions and depends on the specific company. But regardless, always do your due diligence before getting into any trade. Well, thank you guys so much for staying up until the end. I really appreciate all of you guys, and we'll see you in the next video. Peace out.